Howdy, Jacob here. Today we're looking at Cinemark Holdings in the entertainment industry, 3.1 billion market cap on just under 4.6 billion enterprise value. They engage in the motion picture exhibition business. They operate 501 theaters, Central South America, founded in Texas. So their growth has been pretty lackluster. 2.6 billion in revenue in 2014 to 3 billion in 2023 with a massive hit from COVID. They are almost back to their pre-COVID levels on both margin side and revenue side. Pretty good gross margins here, over 60%, mid 60s, with an operating margin back to almost teens, 12 13, 14, 15%. They haven't paid a dividend since COVID, so we'll see if they go back to paying a dollar dividend, which is pretty substantial for them on a per share basis. That payout was greater than 50% on average from 2014 to 2019. The return on invested capital is 5 to 7%, so nothing very impressive there. Balance sheet shows 849 million cash and equivalents with 8 million short-term debt, 2.4 billion long-term debt. So about 2 billion in relation to their free cash flow. I'm going to look at some pre-COVID and then post-COVID levels. You're looking at about 200 million. And so that is 2 billion is a good amount of debt for them in relation to their free cash flow. It did go up from COVID. Again, they weren't making any money. And so it makes sense that they had to fund some projects through issuing debt. But their use of cash previously was heavy on the dividends, a little bit of debt reduction and acquisitions. Recently, they haven't made any money, so we don't really see what they're doing with their money outside of debt reduction. So we're going to have to think about what the company's done the last couple of years. What do we think they're going to do? And that's going to be tough estimates and projections for capital allocation. So we're going to definitely need a margin of safety here. I'll still just do 15% because I just want to see where the company's at with a solid return. So on the revenue growth side, I think they can grow probably maybe with inflation. I'll say 4% because they do have capital allocation going towards acquisitions. In my assumptions, maybe 25% or so. On the margin side, I think they can get to about 6 and 7% with share changes of 1% would be about 30 million. They're not going to offset stock-based compensation, so that's almost increase of 1% a year. Let's say they buy back a little bit of shares, so they're just increasing it 0.5% the next 7 years, a year. Their terminal values, I don't think we're going to get a lot of growth. Not great return on invested capital. Enterprise value 40% greater. I mean, I am taking into consideration debt reduction. So at that point, it'll probably won't be as the difference between market cap and enterprise value, like it won't be as much. So just based on market cap, probably still less than market historical averages. And we're saying it needs to fall 60% before you get the return I'm looking for here. So I will not be itching to go sell, get the company or anything. So for me, I'm just waiting and looking at other companies in the meantime. And I hope you enjoy the video and have a great rest of your day. Thank you.